Hello and welcome to Bloomberg Quint. The fine print of the Finance Bill 2019 is out, and it has brought with it some very big changes for companies facing insolvency in terms of tax implications for investors that are bidding for these assets. And to understand the implications, to understand what those changes are and their implications, I have with me Daksha Baxi, partner at Cyril Amarchand. Daksha, thank you for joining us here on Bloomberg Quint. The first big change, Daksha, as I can see, is with regards to Section 679 that deals with carry forward of losses, right? Help me understand what in the first instance the problem here was, and then in terms of giving relief both to companies under insolvency and bankruptcy code, and in those cases where the government petitions the NCLT under Section 241, 242, relief under Section 79 has come in.
Yes. So basically, when what Section 79 provides is that when there is a change in the shareholding of more than 49% for a closely held company or a company which is not a listed or in which public are not substantially interested, then the losses which are brought forward are not permitted to be carried forward and set off by the new shareholders in the same company. So the company doesn't change, but because the ownership changes to the extent of more than 49%, those losses are not allowed to the company to be offset against their future income. Now, this has been a great pain point for the companies which are going under the international insolvency and bankruptcy code resolution, because what is intended is that the companies are taken over by people who make the investment, but that investment is being made by way of taking over the shares of the company from the existing shareholders and paying off the creditors, right? So hardly any money comes into the company itself. It actually goes to pay off the creditors. So when that happens, and if the new shareholders are not allowed to benefit from the losses which incurred by the previous operating team, then they are at a disadvantage in terms of being able to turn the company around. So now what is being provided, that if the restructuring is, or if the shareholding is changing by virtue of the restructuring, which happens either because of the government making a petition to the NCLT under Section 341 of the Companies Act, or I mean 241, or Section 242, the company is going under the NCLT for the IBC, I mean through the creditors, then if the principal commissioner is given the opportunity of being heard by the NCLT, then in that situation, the company will be allowed to carry forward the losses even under the new ownership, and they will benefit from that. Okay. So that's one major ask which was there from these companies, for the success of IBC, and I think it's a great thing that has come about.
Okay, so this Section 79 change, if I've understood it correctly, is both for companies who are going through the insolvency and bankruptcy code, and also via central government petition under Section 241, 242 of the Companies Act. Now, this Section 241, 242, if I can quote a recent example, has been recently used in IL&FS, right, where the erstwhile board was suspended and the new board of directors has taken in special sort of benefit coming in for an IL&FS and like situations?
I would imagine that that's what it would be. I would have to look at the fine print of the section itself. All we have seen is the notes, memorandums. So we will have to look at it, but it appears to be benefiting those kinds of companies, yes.
Okay. And could you elaborate how will it help IL&FS kind of situations again?
Again, because that's where the government has petitioned for the old board of the IL&FS to be replaced by the new board. They are supposed to carry out the process of restructuring and take the whole group out of the financial trouble by having as many new investors to buy out those infrastructure companies as possible. And the benefit is going to be available to subsidiaries as well as the second layer subsidiaries of those companies. So
this was a huge ask, I understand, from potential investors who were looking at IL&FS and its group assets, right?
And some of the other companies as well, yes, yes.
Okay, Daksha, that is the first change in terms of distressed companies. The second one has to do with applicability of minimum alternate tax, and that is a change to section 115 JB. Could you elaborate what the problem here was and how this tax change now helps?
Yes, so the unabsorbed losses, etc., were not available for deduction from the applicability of minimum alternate tax. So now they are going to be available. Once again, we'll have to read the fine print as to exactly how that will be available. There may be certain conditions, etc. But yes, that is also something which is a very, very positive move.
Okay. If I can just read out the memorandum, they've said that under 115 JB, for calculating book profit, the aggregate amount of unabsorbed depreciation and loss, excluding depreciation, brought forward shall also be allowed to reduce in cases of above mentioned companies, which is both companies under the insolvency and bankruptcy code, and both and again where, let's say, the central government has made an application under 241, 242, right? Okay. The third and final change in the context of distressed companies has to do with 56.210 and 50 CA. Daksha, we talked about it in the story that we put out on Bloomberg Quint in terms of expectations for companies under IBC. As I understand, both of these are anti-abuse provisions. Could you first sort of help us understand what is the taxability of distressed companies under these two sections, and then we'll come to how do these changes help?
Right. So in the first place, when the distressed companies are taken, as I said, whatever money is being brought in is obviously a significant at a significant discounted value of the company, basically, because the loans are being paid off by the acquirer. So the acquisition of share really takes place at a very low value. Most of these companies are sort of infrastructure companies or companies who do have valuable assets. And so for the purposes of valuation of shares of these companies, what is used is the fair market value of those assets. So when the fair market value of these valuable assets is high, despite the fact that it does get reduced by the loans, it still has the value is still much higher than what the investor is investing at. What that means is that if the value is high and the investor is investing at a lower price, then the investor is also required to pay tax on the difference at 30%, which is a very high tax cost to the investor, not having really earned anything, but just for his ability to take a risk to turn this company around. So getting this exemption from that provision is a very, very big sort of relief to the investor for not having to dish out that 30% tax. Similarly, the shareholder of these companies who's selling the share, if the shareholder receives less than this fair market value of the shares, it is deemed that the shareholder has realized capital gains. Okay. So there also the shareholder really does not have the ability to ask for fair market value of the shares, because otherwise nobody will invest. Yes. So there also the exemption has been provided, and therefore that is a very big relief for the success of IBC resolution.
Okay. I will just quickly read out, and if you can sort of explain to us again, are there going to be specific situations where that might be useful, or this is going to be across? They have said that in order to provide relief to such types of transactions in terms of distressed companies, from the applicability of sections 56.210 and 50 CA, it is proposed to amend these sections to empower board to prescribe transactions undertaken by certain class of persons to which the provisions then shall not be applicable. When they say board, I'm guessing the CBDT will have to...
it's sort of not given a blanket exemption, but the board will notify what are the conditions which need to be satisfied for claiming exemption from these sections.
Okay, so because it's sort of housed under facilitating resolution of distressed companies, it's safe to assume that for IBC cases this might come in.
Yes, that's right. Yes. Yes.
Right. Okay. Thank you, Daksha, for your quick sort of response and explanation as to the various tax changes that have come for stressed companies. Stay tuned to Bloomberg Quint on video and on our website for a detailed coverage on tax-related changes in this budget. Thank you for watching.